We welcome in Diane King Hall, host of Morning Movers, to talk about some of the names that are grabbing attention here. And we'll start with Snap, which is down after its quarterly report.
Yeah, look, it doesn't matter that they beat expectations on the top and bottom line for Snap. It's all about guidance, and they pulled their guidance. Their point is these macro conditions, which are worrying, not just for consumers, but businesses alike. So we're seeing the echoes of some of the commentary that we've heard on a slew of different earnings calls. You're looking at Snap down nearly 15% this morning, extending the losses that it's already suffered this year. To catch people up in terms of the trailing quarter, they did post a loss of 8 cents a share. The expectation was for a wider loss. She was expecting a loss of 13 cents a share. Revenue came in at $1.36 billion. That did slightly top expectations. They did see user growth in line with expectations. Daily active users was 460 million. She was looking for 459 million. But the big red flag for investors is no Q2 guidance. So they declined to offer that. They cited the macroeconomic uncertainty, essentially spooking investors. The tone in terms of management, in terms of the commentary to shareholders, that it is facing headwinds at the start of this quarter. They said they'll continue balancing investment with the revenue trends. Now, obviously, the risk for them is ad revenue. They get basically the entirety of their revenue from advertising, and obviously that is a concern when you have tariffs and, will companies cut back? That's certainly one of the areas that companies could cut back is advertising, so that is a risk for Snap in terms of how analysts see this. Analysts are lowering their views on it this morning. B. Riley has lowered their price target on Snap to now $10 a share, which is a little upside from here, but not much. Rosenblatt also lowering its price target on Snap. Nicole.
This was such a fun name, a name that was close to $20 earlier this year, last summer. It was $17.33 was the high, but a name, I'm just going to go crazy here and pull up a 3-year chart because I know it was way higher than that. It used to be $30 on the 3-year chart. That was the highest point, and I know it was much higher than that prior. Sort of what happened to Snap, right? And what happened to so many of these names that have come down off of their highs, and that's the big story. And lack of clarity and pulling guidance on Snap, you wonder, it's the macro uncertainty. They're not facing a ton of tariffs, I don't think. So it's just whether or not people sign up.
Well,
right?
No, I mean, it's whether or not the companies continue to spend on advertising. If companies pull back because of the tariffs, for instance, that's an easy place to make cuts because they don't have to do the advertising for Snap. And I think you make a great point, Nicole, about how not just its share price performance, but once upon a time it was seen as a potential jewel. Meta wanted to own it once upon a time, and now it's a far cry from how attractive it was in its glory days.
Yeah.
So again, significant pressure today, accelerating the losses that it has had year to date, similar to the story we've seen across tech sector and social media stocks has been under pressure. Obviously, a very different story from Meta. Meta has, a much better growth profile on a year-over-year basis, despite the troubles it's faced this year.
And I'm looking at the same time, I just pulled up the Netflix chart. So I still have 3 years up here. That was $162 3 years ago. Now, $1,127. Netflix, a completely different story. So while they seem similar, they are so different, especially with the share price. Let's get to the next one. You're looking at the cruise lines, right?
Yes, this is Norwegian Cruise Lines out with their latest quarterly numbers. They reported mixed numbers. Adjusted EPS was 7 cents a share. That was a miss. The street was looking for 9 cents a share. Revenue was $2.13 billion. The street was looking for $2.14 billion. Actually, they missed on both metrics there. So you're seeing shares drop more than 10% right now. So disappointment on both its top and bottom line. And then here's the worry in terms of the road forward from here, or I should say the seas forward. I don't know the right terminology right now. But basically, although they see growth over the next 12 months, they did say they see some softening in demand in terms of forward bookings. So they've given mixed guidance. They maintained their full year profit guidance of 205 per share, but they lowered their net yield growth guidance, and that's a key metric that essentially tracks unit per capacity. They said, look, there are potential, the CEO said there are potential pressures to the top line. They talked about some cost saving initiatives that they're trying to do, but Wall Street does not care today. If there is weakness, they are selling it off.
And at the same time, this week, Royal Caribbean posted a profit outlook, record bookings that they have had, and they boosted the outlook, I believe. And so it's very different with these two. So which one is on point, right? I mean, maybe this is how they both feel. I mean, maybe they're slightly different, but you have one sort of being a little more cautious, and that's also the CEO's job. Some people like to undershoot. Some people like to be more positive.
And but also, I mean, Royal Caribbean is best in class. They've got Utopia of the Seas. They've got Icon of the Seas, those massive ships. So, they are considered the better of the bunch. But even Royal Caribbean, in terms of its share price, that weakness year to date, it's done great year over year. But if you're going to own one in this space, you want to pick the leader, essentially. So Royal Caribbean has been that, and customers have stuck with that. When customers are sticking with their cruise liner, they're going to stick with the one they've been going with. So in this case, it's going to be a Royal Caribbean. I was talking to an analyst earlier, and he also talked about Carnival as well. But Norwegian really has a difficult landscape in front of it. Not that Royal doesn't, but it shows that the demand picture is better for Royal Caribbean than it is for Norwegian.
And that stock ran up Royal Caribbean and then sold off. Like so many of these stocks have, whether you have the bookings, the record bookings, the profit outlook raise, the guidance raise, still down year to date, down week to date, even with some good numbers. Last but not least, Western Digital.
We finally have a winner today in terms of the investor reaction. Shares of Western Digital higher right now by a little more than 5% off the back of their latest quarterly numbers. Western Digital reporting a beat. On the bottom line, adjusted EPS was $1.36 a share. She was looking for $1.13. Revenue was $2.29 billion. Their cloud segment, that accounted for 87% of total revenue, so nearly 90% of revenue there. Although it saw a quarterly decline, it did grow year over year more than 30%. They talked about just essentially the strength of their product portfolio for that. In terms of their guidance, they're guiding for quarterly $1.45 for EPS. That beats consensus. For revenue, they're guiding for $2.45 billion. That also beats expectations. The company said, CEO said, Western Digital executed well in the fiscal third quarter, achieving revenue at the high end of the guidance. And they called out the geopolitical issues, uncertainty, and said, even in a world marked by geopolitical uncertainty and shifting tariff dynamics, one thing remains constant: the exponential growth of data. They also are authorizing a quarterly dividend program, so that shows that they believe in the company.
Diane King Hall, great to see you. A few names that we covered here. Thank you very much. We're in the thick of earnings season. After the bell, we'll have Meta, Microsoft, Qualcomm, eBay, a lot of names to watch.